Welcome to Talk Tickers. We're doing a deep dive today, turning raw earnings call data into strategic intelligence.
That's right.
We looked at the Q3 2025 transcript for Clearway Energy, ticker CWEN.
CWEEN.
And our mission really is to figure out why this report caused such a stir. I mean, it wasn't just a good quarter. It felt like something bigger.
Absolutely. The market reaction the day after was pretty intense. It wasn't just a small beat.
Yeah.
This felt like a defining moment because they didn't just deliver great cash flow for Q3. They gave this really clear, pretty aggressive outlook all the way to 2030.
Okay, so let's jump right into that headline beat.
Mm-hmm.
The financials. If you were looking at the consensus for GAAP EPS.
Yeah, generally accepted accounting principles earnings per share.
Right. Analysts were expecting, something like 32 cents to maybe 7.42 cents. Pretty conservative range.
They just smashed that. I mean, completely. Clearway delivered GAAP EPS of $2.
$2.
Yeah. That kind of beat, you're talking a surprise factor well north of 300%. And it was driven by, cash flow.
And the revenue piece helps frame that, right? Revenue was $429 million.
A slight beat there against consensus.
Now, we should probably mention the top line actually fell 12% compared to last year.
Yeah, year over year it was down. But honestly, the market just seemed to shrug that off. They were way more focused on the cash generation metrics.
Which were
flawless, basically. Adjusted EBITDA hit $385 million. And the really critical one, cash available for distribution, CAFD, that landed at $166 million just for the quarter.
$166 million CFD in Q3. Okay, so what specifically drove that number so high? Was it just luck?
Well, management pointed to two main things. First, really strong wind resources in their key areas, just, the wind blew more.
Okay, makes sense.
But also, and this is crucial, cash contributions starting to flow immediately from recent growth investments they've made, highly accretive ones.
So the M&A and development is already paying off.
Exactly. They're executing, and the cash is showing up right away.
And just to round out the quarter, they confirmed the dividend, right?
Yep. Declared 0.4528 £10 per share. So confirming that dividend growth is still on track, which, after a beat like that, you want to see that commitment.
Definitely. So massive beat, strong cash flow.
Yeah.
You immediately look forward, right? Is this sustainable? What's the guidance look like?
And that's where the confidence really came through. For the full year, 2025 CFD guidance, they tightened the range, moved it firmly into the top half. It was $400 to $440 million. Now it's $420 to $440 million.
Okay, so narrowing it upwards like that signals real conviction they can hit the high end for the year.
Exactly. High conviction on execution for the rest of 25.
But the market probably reacted even more strongly to the look ahead beyond this year.
Oh, absolutely. That's what really gave it legs. They introduced the 2026 CFD guidance.
First time seeing that number.
Right. And it's $470 million to $510 million.
$470 to $510 million for 26. That gives a very clear line of sight then. It confirms this isn't just like a one-quarter wonder. The growth is actually picking up steam into next year.
Precisely. And that near-term acceleration, it's really underpinned by disciplined capital deployment, especially M&A.
Right, they mentioned a deal announced back in October.
Yeah, binding agreement. They're acquiring a 613 megawatt operating solar portfolio. Pretty spread out, actually, across 8 states.
Okay, 613 megawatts, that's sizable. And they're putting real money behind it, like $210 to $230 million in corporate investment.
Yep, serious capital.
But the returns they're projecting, a 12% half D, that seems quite aggressive. How confident are they that they can actually hit that, especially across so many states?
It's a fair point, but look, their track record is pretty solid here, and they were specific. They expect a 5-year annual CFD yield of at least 12%.
Okay, greater than or equal to 12%.
Right. And about $27 million in extra annual asset CFD starting in 2027. The point is, this high return validates their M&A strategy. It's not just about getting bigger. It's about adding cash flow quickly to, help fund future growth and keep the payout ratio down long term.
Okay, that makes sense. And that ties into maybe the biggest reveal on the call. Stretching the vision way out past 2026. They set a new long-term target.
This is why the stock popped, I think. They put a stake in the ground for 2030. A KFD per share target of $2.90 to $3.10.
$2 and $3.10 by 2030. And if you compare that to where they are now, or the midpoint for 2025, what kind of growth rate is that?
It works out to a compound annual growth rate, a CAGR, of 7% to 8%.
Okay, 7 to 8%. Why is that number so significant in this sector?
Because, I mean, for typical regulated utilities or even independent power producers, IPPs, the average growth rate is usually more like, 4% to 6%.
Right.
So by targeting 7% to 8%, Clearway is basically saying we're aiming to be among the absolute premium players. It signals a superior, consistent growth story compared to peers.
And critically, they're not betting the farm on just one thing to get there.
Yeah.
They talked about multiple paths, starting with optimizing their existing assets, right?
Yes.
Fleet enhancement.
That's right. Repowering. They confirmed every single wind project they have that's eligible for repowering through 2027 is now lined up for investment.
Every eligible one.
Yeah. The plan is to repower over 1 gigawatt of wind by 2029. They mentioned specific projects like Mount Storm, San Juan Mesa.
And these repowering projects, they're attractive because
they deliver really predictable high-yield cash flows, often in that 10% to 12% CFD yield range we talked about with M&A. Plus, it extends the life of the turbines and often comes with new long-term power purchase agreements or PPAs. It just makes the existing fleet work harder for longer.
Okay, so solid foundation with repowering. But then the conversation really shifted, didn't it? Towards the future, technology, huge demand drivers, specifically data centers. That seemed to dominate the Q&A.
Oh, yeah. The scale here is just immense. Management said they've either signed contracts or been awarded deals for 1.8 gigawatts of PPAs in just the last year, all specifically to power data center.
1.8 gigawatts just for data centers.
Wow. But the really game-changing part is their development strategy. They're not just selling power, they're planning these huge multi-technology generation complexes.
Multi-technology, like mixing solar wind.
Exactly. And potentially other things, too. We're talking sites ranging from 1 gigawatt up to nearly 5 gigawatts, designed specifically to be co-located with data centers across 5 different states.
5 gigawatts. That's city-scale power. And these are long-term projects, right? Coming online late 2020s into the 2030s.
Yep. CODs span from 2028 well into the next decade. Now, this is where, the slightly controversial bit came up.
The flexible generation part.
Right. The potential need to include flexible generation, specifically natural gas, paired with the renewables in these complexes.
Why? Just for backup?
For reliability. Hyperscalers, the huge data center operators, they demand absolutely bulletproof 247 power. Intermittent renewables like solar and wind can't always guarantee that on their own. So adding flexible gas is seen as a strategic necessity to win these massive, incredibly valuable contracts.
Okay, but how does the market feel about that? A company focused on renewables bringing potentially more natural gas online, even if it's alongside renewables.
Management was super careful here, very deliberate. They made it crystal clear that the 2030 CAFD targets that 7% to 8% growth rate we just discussed. Those targets do not depend on these flexible gas components being built or these huge multi-gigawatt complexes coming online.
Okay, that is absolutely critical then, isn't it?
Hugely important for the investment thesis.
It means their baseline 2030 guidance, the 7-8% CAGR, they believe they can hit that just with their current renewable pipeline, the repowering, the contracted M&A.
Correct. Which implies that it or when these massive data center complexes do get built and start generating cash, that's all potential upside, significant upside beyond the guidance they've already given.
They've essentially built optionality like an accelerator pedal into the model.
Exactly. So let's shift to how they actually pay for all this because, 7% to 8% growth needs a lot of fuel, a lot of capital.
Right. What's the funding strategy?
It's all built around being prudent and aiming for a self-funding model.
Self-funding. Okay, what does that practically mean for investors?
The core piece is their long-term target for the payout ratio. They're aiming for less than 70% beyond 2030.
Less than 70%. So they plan to keep 30% or more of their growing cash flow inside the company.
Precisely. And that retained cash is the engine. They redeploy that into new growth projects, M&A, development, repowering, that hit those attractive, say, 10% plus CFD yields.
Which means less reliant on issuing new stock.
Exactly. It reduces the need for external equity, which can dilute existing shareholders. Very important for long-term value.
Okay, so retained cash is pillar one. What about debt?
Prudent use of corporate debt. They're targeting leverage between 4 and 4.5 times corporate debt to EBITDA, pretty standard range.
And any equity issuance at all.
They mention using moderate, discrete amounts of accretive equity. They gave an example. They raised about $50 million this year through their ATM program that's at the market and their DRIP, the dividend reinvestment plan.
So a balanced mix, retain cash, manageable debt, and just small opportunistic equity raises. Sounds sustainable.
Very much so. And it positions them really well to catch some broader macro tailwinds too, particularly thinking about their existing portfolio.
How so?
Well, think about their older wind and solar farms. Many have project-level debt attached to them from when they were built.
Okay.
Management pointed out that as this debt gets paid down, amortizes over the next decade, and as the original PPAs expire, those assets essentially become debt-free.
Like paying off the mortgage on a rental property, like you said earlier.
Exactly. And if power prices stay strong or even rise driven by all this data center demand we're talking about, then these older, now debt-free assets could generate significantly more cash flow. It creates this potential tailwind, maybe low single-digit annual growth, just from the existing fleet getting more profitable on top of the 7% to 8% contracted growth.
So it's like compounding returns coming from different angles. The new growth and the existing assets potentially kicking in more cash later.
You got it. Multiple layers of growth potential.
Okay, so we've laid out the story. Huge beat, clear path to premium 7-8% growth, self-funded, plus this massive data center optionality baked in. Now it's time for that segment where we get a bit creative.
Let's do it. High conviction time.
We're going to pitch an aggressive, but we think plausible, trade idea based only on the narrative we just discussed from the earnings call. And we have to say this loud and clear. This is not financial advice. Seriously, informational purposes only.
Absolutely. Do your own homework. But the core idea behind this trade is simple. The market, we think, is still valuing CWN kind of like a boring, slow growth utility.
Right. It hasn't fully priced in this shift, this step-changing growth visibility out to 2030.
That 7% to 8% CAGR, backed by the repowering, the M&A, that 4.5 GVW late-stage pipeline, we think it's just fundamentally underappreciated right now.
So instead of just buying the stock, the idea is to use leverage to capture potential future multiple expansion. We're talking about LAPS.
Long-term equity anticipation securities, basically call options, but with expiration dates way out in the future.
So the trade idea is
You'd look at purchasing LAPS call options, maybe expiring in 2027 or even 2028. And specifically, deepen the money call.
deep in the money. Why?
Because that structure gives you exposure more like owning the stock, but with less initial capital outlay. You're trying to capture the upside if the stock gets re-rated higher, which is the core bet here.
Okay, so the bet is that the consistent 7-8% growth, plus the high yield projects, plus maybe some positive news flow on those huge data center complexes, all that will eventually force the market to give CWN a higher valuation multiple.
Exactly. Before those 2027 or 2028 options expire, you're betting the market wakes up to that $2 to $3.10 CAFD per share target for 2030 and realizes this isn't just a yield stock anymore.
It's a premium growth story hiding in plain sight, essentially. And the LEAPS give you leveraged exposure to that potential re-rating. Again, aggressive idea, not advice.
Highly aggressive. Needs careful consideration. Okay, so just to quickly recap our deep dive on Clearway's Q3, the quarter itself, massive EPS beat, really driven by strong win, and those recent acquisitions kicking in cash flow.
Yep. But the bigger story, the reason for the excitement, was management laying out that really clear, fully funded path to 7% to 8% compound annual growth all the way out to 2030. That's a premium target in this space.
Definitely. And they're getting there through smart high-yield M&A, that big repowering program for their existing fleet, and sticking to that self-funding model, keeping the payout ratio below 70% long-term to reinvest cash internally.
And this whole structure just seems perfectly timed to capitalize on this, tidal wave of demand coming from data centers.
Right. Which leads us to the final thought, something for you, the listener, to chew on. Remember, Clearway's current 2030 targets, that 7-8% growth, it relies on their committed renewable pipeline.
Right, they were clear about that.
So think about this. How might the market value this company differently if, say, in the late 2020s or early 2030s, they successfully demonstrate that one of these massive 5-gigawatt multi-technology complexes, maybe even one incorporating some flexible gas, is operationally feasible and highly profitable?
If they prove that model works.
If they prove that model works at scale, it could fundamentally change how investors see the company. It might move beyond just premium utility and unlock a whole new level of growth potential, far beyond even the current 2030 target.
Like kind of de-risked, self-funded optionality on potentially transformative growth. Yeah, that's pretty rare.
It is something to watch closely.
Absolutely. Okay, that wraps up this deep dive. Remember, everything we discussed today is purely for informational purposes. Please do your own research and diligence. This is not investment or financial advice.
Definitely not. Thanks for tuning in.
We'll catch you on the next Stock Tickers Deep Dive.